Hi guys, welcome back to another Wyckoff trading lesson video. In this video I'm going to talk to you about the difference between springs and sign of weaknesses. So I've got two charts that I'm going to show you and show you some of the common characteristics, so hopefully this will help your trading, help you trade springs better. As you know, I prefer to trade springs as opposed to breakouts. I think they have a higher probability of working if you can successfully identify them with some of the rules I'm going to show you in this video, and also your risk versus reward ratios are better and it's skewed asymmetrically to the upside. So let's jump straight into it. So this is looking at Apple, and this is the bottom of the 2008-2009 financial crisis. I'll explain what these black arrows are when we get deeper into the analysis, but they're basically entry points in the strategies that I've been developing for the optimal ways and having rules and criteria, so the optimal ways to trade springs and also trading breakouts too, and those rules are listed in the Wyckoff watch list. If you want to check that out, there is a link below. So let's go start from the left hand side of the chart. So we can obviously see a significant decline, okay, coming down into the selling climax. What do we note that supply does going in, or supply and effort going into the selling climax? Well, we can see that effort and supply greatly increase, followed by a period of decreasing absorption from left to right. So obviously at this lowest point here, we see this increase in effort. So effort has greatly increased and supply has greatly increased. Okay, this is where people are, and especially weak hands in particular, are capitulating. But this is the thing about trading and your emotions. When was one of the optimal times to buy, and obviously where this black arrow is, I think it's the optimal time to buy, and that's where my pivot spring strategy would have given you the green light to be buying right in there. But as you get that feeling, as you start wanting to capitulate, you have to ask yourself who's on the other side of this trade, who's soaking up these shares, and it's going to be the composite operator. The composite operator, so remember, let's just write this down. So the CO, okay, really wants two things. They want liquidity. My handwriting's quite neat for a Sunday morning. Liquidity, and they also want value. So what are they finding at these price levels down here? As weak hands are capitulating, they're seeing liquidity and they're seeing value, and that's why they're soaking up shares. So you think about it, if we're looking relative to what we've seen previously, that you can see on this chart in July, August and September, relative to what we see in late September, October, November time, okay, this is obviously the composite operator footprint. Apple is a huge stock, so by seeing volume and effort this high, we know the composite operator is going to be active. They're doing something, and it's our job as Wyckoffians to decide and try and decipher what they are up to. What are they doing? So we can see this significant absorption. We then see the largest rally from the selling climax into the AR. Okay, that's very, very crucial, because that indicates to us, and I'm going to go to a black now, that indicates to us this rally into the AR acts as a change of character. So this is the largest rally that we see within the prior downtrend. It comes on this very, very high relative effort. We then see the move into the selling climax that has some quite significant demand tails. Hopefully you can see that as well. What are these demand tails suggesting to you? Okay, weak hands are still capitulating, price is going down, but because of the size of the effort as well, who do we think's on the other side of the trade? Who is soaking up all of this available liquidity that's being presented to them? It's going to be the composite operator, isn't it? So then we come through and we see a secondary test and a quick rebound into the structure. So again, what's this saying to you? It's suggesting that there's strength there for price to recover so quickly back into the structure, and it also happens whilst, okay, supply is now decreasing as well. So supply is decreasing for this secondary test, and we see a quick reversal back into this structure. That's our first indication that there's some strength there, because we're seeing supply decrease. When price goes below support, it's being quickly bought up again, and it's returning back into the structure in short order. Now, what I then do is define this as the lower boundary of my trading range. So this black dashed line that's going to be at $11.31, this is now my lower boundary of support. So this is where I'm then looking to use that level for my pivot spring strategy criteria and see if I get a green light entry. So as we come along further, what do we note even more so? Or even more, okay, we note this continued decrease in supply as we come into the spring. So again, this is one of the things we're looking for in accumulation structures. We're looking for that absorption of the supply. Indeed, that is happening. So I'm now just going to highlight the bar, and let's talk about the bar. So remember, the successful secondary test that we saw in phase B had a very quick return back to the structure, indicating strength. What we don't want to do is see price kind of just meander below support, no real strong recovery back into the trading range, because that suggests that there's not kind of real pent-up demand there and ready to buy shares at these quite historical low prices in the case of Apple. So we want to see that quick recovery. So one of the rules, and it's all in the Wyckoff watch list, one of the rules is a quick recovery in a certain amount of days, and we also want to see it happen on a bit of an increase in demand. The more we see an increase in demand, the more conviction we can have behind that this trade is going to be successful. So what we can see is a commitment below support on this day, the quick recovery that comes on increasing demand relative to what we've seen previously within this area here. So the entry would be at the end of the day when we know there's going to be a close above support. And if you're looking at this candle bar as well, this is where we can start doing tape reading skills. But remember, so we want to be doing our tape reading skills, but you need to have the context of the larger structure that you're looking at as well. So if we're just looking at this entry bar down here, okay, this entry bar here, what we can see is a bar that looks something like this. The open is there, a very high body, okay, and obviously demand was increasing. So we had the open here, we had the close here, so that's a very bullish candle bar in and of itself, that we've got the open pretty much at the low of the day, and then we're closing, you can see that we're probably closing kind of within 2% of the high of the day. So that's a very bullish candle bar. There's a lot of demand there, but remember, we're trying to decipher what's been going on, what's the CO, the composite operator, been up to prior to this happening. So it's all about putting this candle bar and this potential entry point and having your own strategy. And by all means, you can copy mine, tweak it, change it, make sure it suits your personality, define your own rules as well. Okay, it's putting that into context of where are we looking to take this entry point, given everything that's happened previously. Is this going to give us a very high probability of winning, and is it going to be favourable on a risk versus reward basis too? Obviously, you would nearly been buying Apple at the low down here at $11.80, and what's the share price today? It's, I can't even remember, it's something like $200 something. So you would have performed very well. This is another reason why I made the recession survival course, is because I think opportunities like this are going to come about again in some very good companies such as Apple, or wonderful companies such as Apple. So it's looking to then take advantage of these and have your own strategy in place to then take advantage of these when it presents itself to the market. So it's being able to spot the distribution structures forming at the top, and we're going to look at one of those, BlackRock, we're going to look at in a minute. And then it's also being able to take advantage of the buying opportunities at the bottom, but having a repeatable process that allows you to do that. We then see a successful high-low test in here, and again on this testing action, need to go, have I got the right colour? No, back to black, as Amy Winehouse said. So again, for the testing action, the high-low, okay, that's a successful high-low test, and I've just drawn this blue dash line. Some people like to use apex structures as well to define trading ranges and potentially looking to buy breakouts. By all means, go and do that, but remember, have the Wyckoff methodology, your structural phase analysis, understand the supply and demand, effort versus result, before you start just buying apex breakouts. Okay, very important to put everything into context. So on the reversal of the test, there's also an optimal entry. I prefer doing it on the spring, but you can put rules in place to buy the reversal of the test. When I've been and back tested the test, I actually find it's more optimal to be buying the springs. It just has a greater probability of working out, gets you in at a better entry as well, so your risk versus reward is more favourable too. But by all means, go and do your own thing. So then what happens, let's just talk about, I know this was going to be springs and breakouts, but what we can then see is a reversal backing up action, reversal, breakout, that's that bar up there, and again I got rules for how to enter that. So on that bar there, that meets my rules, so that's where I'd be looking to take a trade as well, and obviously this then accelerates. So again, if I was trying to scale in and build a campaign position here, what I'd be looking to do is put on a probably the majority of my position here, so maybe 60-70% down in the spring. But then if I was looking for add-ons, what I'd be looking to do, and I call it the burp strategy, okay, backing up, reversal, breakout bar is where I'm looking to take the trade. So that's in there. That was a rubbish arrow. So that's in there. So if I'm then looking to campaign a stock, that's where I'd then be looking to add to my position. So put on the remaining, say 30 basis points, 20 basis points, whatever, of the position. And you can obviously see that supply continued to decrease. There was that increase in demand just before the breakout bar itself. And again, the backing up action was able to hold previous resistance PR of the AR level of about $16.63, well, of $16.63. So again, that's another place where I would have been looking to take a position. So again, it's having the Wyckoff methodology, but it's coming up with your own repeatable strategy. Where are you looking to enter trades? Where's the optimal places to be taking trades? And I think that's on springs, it's on potentially breakout bar itself. So I've got another strategy, there's 3, and this here would have been the, I call this the sign of strength breakout bar. So that's where you also would have been taking a trade. So there's 3 entries there. Okay, 1, 2, and 3, and that's how I look to trade using the Wyckoff methodology. I think they're the optimal places. So you've got the pivot spring strategy, you've got the sign of strength breakout bar strategy, and also the backing up reversal breakout bar strategy, which is a bit of a mouthful, so I just call it BERT. Again, all of these are listed. The criteria is in the Wyckoff watch list. The breakout strategy course talks about these 2 up here because it's a breakout course, these 2 at length as well. And obviously I'm trying to identify these type of breakouts in the Wyckoff watch list. So let's go and look at a distribution structure. Now this is a distribution structure for BlackRock. So I have just put in here, okay, another black arrow. That was identified as a secondary test as sign of weakness. But at the time, it also met the pivot spring strategy criteria. So that in there would have been a pivot spring strategy, okay, entry point. So I would have been looking to take a trade in there, and to the top of this structure was a plus 30% gain. So actually, if you have a repeatable structure and you know what your targets are, so those of you that follow me know I'm trying to cap my losses at between around -8, -12%, so really kind of -10% is where I'm targeting. But my upside, what I'm doing is I'm then scaling out 50% of the position at a 15% gain, okay, which would have been about there, and then I'm looking to scale out the rest at around about a 25% gain. So my average gain is going to be around that 20% mark. So my gains are twice the size of my losses, and I have a better than 50% batting average. So that's where I would have been taking a trade in there, where I've highlighted yellow. So what we can see is a significant uptrend. Okay, we can see a significant uptrend, and then the move into our AR acts as a change of character. And do note how much of the previous rally, okay, into the buying climax, this AR takes back, basically going from $227 right down to $165. So big change of character, and slices through areas of previous support. So already, although we're coming into a reaccumulation structure potentially, because we just had a significant uptrend, our bias is going to be reaccumulation. So we're looking for confirming or disconfirming evidence. But because of the size of the reaction into the AR, this change of character event, slicing through a lot of previous support, erasing the gains of this previous rally, okay, already we're slightly kind of looking at this and going, that's a little bit bearish, but we've still got our bullish bias. So remember, we're just looking for evidence. What we can see here is a move into the secondary test, and then we move into the upthrust action in phase B. And do just note the price strength in phase B. So what I'm going to do is just do it with a, let's go for blue. Okay, so one of the common characteristics of an accumulation structure or reaccumulation structure is how long does price spend in the upper half. Remember, phase B in the Wyckoff process or Wyckoff methodology, phase B is all about building a cause. So are we building a cause for distribution or accumulation? And it's not kind of set in stone. You need to look at everything in totality rather than just pin your tail on one donkey, so to speak. So what you can see here is price spends the majority of the time in the upper half of the structure, and then we see a quick move down below, and price very briefly commits below the price support of the AR and then rebounds. So we've already discussed about the pivot spring strategy, entry point right on this bar here, and up until this point it would have been warranted. You would have been taking an entry there. Is every single trade you take going to work out for a long-term campaign? No, it's not. But actually, can you make gains of 15, 20, 30% very quickly? Yes, you can. Remember, this is on a daily time frame, so we're making 30% or so in about 10, 14 trading days, which is pretty darn good. And again, it comes back to knowing your strategy and knowing where you're trying to get in, where you're trying to get out, and what average gain you're targeting and what average loss you're targeting, so you can have those favorable risk versus rewards. So I would, like I said, would have been taking a trade in here. We can see a quick rebound in here. What we can see here is a significant increase in demand, okay, and a significant increase in effort, but yet price only gets to here. So this is our first sign of maybe this is going to start turning out to be a distribution structure. So what is the result of all of this effort, all of this demand? Well, is price able to overcome the prior resistance? No, it's not. It's not able to overcome the buying climax, the secondary test in phase A, the upthrust in phase B. So what is the result? Is the result bearish or is it bullish? Well, even though you see all of this demand, and this is where amateurs can slip up, they see all of this demand coming through, all of this effort, and they think it must be good. It must be the composite operator buying in. But yet, what is the result? The result of that move, is it bullish or is it bearish? The result is actually bearish. We make a structural lower high. What then happens is we can see a attempt to rally here that's quickly met with large effort and large supply. I'm just going to highlight that bar. Hopefully I'm on yellow again. Yeah. Okay, that bar in there. Okay, as price then tries to rally and recover, we can see a very significant effort bar. We see no real demand in the intervening period between. So in between where we saw all this effort and demand into where we see this big increase in effort and supply as price tries to overcome previous resistance and fails. Okay, we see no real demand within that period. Okay, and then like I just said, we see that effort, we see that supply coming, and price starts moving to the downside. Following that, we then see another increase in effort in this region here. Okay, effort's increasing. In this region here, note what the price volatility is doing as well. This is one of the kind of nuanced points, and I'm just going to highlight this whole area here. So this whole area here, what we want to see, if this is an accumulation structure, and this is a nuanced point of the methodology, if it's an accumulation structure, what we want to see is we want to see supply and price volatility decreasing throughout the structure. We don't want to see it greatly increasing, because that's going to suggest that there's a lot of supply coming to the market. There's more of a battle between supply and demand going on. That's why you get these really wild price swings. And that's going to have more the common characteristics of a distribution structure. So as we move later on to this structure, and it's really only after, I just need to change my color again. If I go for my highlighter and we go for blue, okay, everything before this point, okay, we're thinking reaccumulation, and this is why we need to be very kind of dynamic and non-linear in our thinking and be able to change your bias very quickly. Okay, you need to be able to switch from bullish to bearish very quickly, and you can't be kind of stuck in your thoughts or stuck in your ways of thinking. Okay, as the market gives you new data and the market participant behavior starts revealing itself more clearly, that's when you need to be able to switch. So everything up until this blue line here, I'd be thinking this is reaccumulation. I've taken a nice pivot spring strategy trade in here, but now what I start to see is I see an increase in effort and demand, but yeah, I'd see no result to the upside. I see a very weak rally into here, suggesting this is weak hands buying within this region here. I see an attempt to overcome the previous resistance of the upthrust secondary test, the buying climax, but yet no result to the upside. I see an increase in supply, increase in effort come on this bar in here. I now see another very weak attempt to rally. Okay, you can see that in this region here. I now see another really weak attempt to rally, so suggesting weak hands buying up here. The composite operator isn't buying, not supporting the breakout. I then see a lot of increased volatility here, which has signs of the CO selling off the top. Within this region here, we see that price volatility really increase, we see the effort increase, we see the supply increase, and what you can see is we come down here into this region where we'd be looking at our sign of weakness, potential spring. Remember everything I've just said as well. Okay, we're looking at this region here, but we're just looking at price volatility here. This is not what we want to see as we're coming into a spring. We don't want to see this huge increase in price volatility like this. If you compare this decline, okay, to this decline, what decline is more bullish? Well, it's going to be the first decline is more bullish because it's not got these really wild price springs from side to side, up and down. Okay, this is very, very volatile. It's not something we want to be looking to do when we're trading, okay, because it's very likely we're going to get stopped out, and we can see the composite operator selling off the top beforehand. We want to see supply, as we saw on Apple. If I flick back, okay, note how we see price volatility over here is very high. We see supply and effort very high as well in this region. But as we come across, okay, into our spring as well, note how price volatility has been decreasing. Note how supply has been decreasing as well. So that's some of the keys that you want to be looking at, and you also want to have a repeatable process for when are you taking entry points. What is your criteria? Okay, give yourself a checklist of 3 or 5 points that you're looking for to go, okay, green light, green light, green light, yes, I can now take an entry on this candle bar. Again, that's going to make your trading much more consistent, much more profitable. If you want to see the rules that I've got for my trading, go ahead and check out the Wyckoff watch list from 20 quid a month. There's a link in the description, and if you're new to the channel, please go ahead and subscribe, like the video, and comment down below if you have any questions.